Hey everyone, welcome back to Wealth Finance 61. Let's get into it.
The economy appears chaotic on the surface, yet beneath the noise, it behaves like a machine. It is not driven by mystery, but by repeating patterns of human decisions. Booms and busts feel random only when viewed too closely. From a distance, the mechanics become visible and disturbingly predictable. Every economy, regardless of country or ideology, is built from the same foundation. That foundation is the transaction, an exchange repeated billions of times each day. A buyer gives money or credit, and a seller provides something of value. How this simple interaction quietly shapes the entire financial world. Prices, wealth, and growth emerge from nothing more than aggregated exchanges. When spending rises, incomes rise somewhere else in the system. When spending contracts, incomes must shrink with equal force. The machine never escapes this accounting identity. Markets are not abstract concepts, but collections of these constant exchanges. There is a market for goods, for services, and for financial claims. Each operates under the same arithmetic logic of spending and income. Complexity emerges only from scale, not from different rules. Within this system, several actors continuously interact and compete. Individuals seek consumption, businesses pursue profit, and banks extend credit. Governments tax, spend, and attempt stabilization. Yet one participant holds powers unlike any other. The central bank stands apart from ordinary economic agents. It does not produce goods, nor does it consume in the usual sense. Its authority lies in controlling money and influencing credit conditions. This control quietly reshapes incentives across the entire machine. Credit, not money, dominates modern economies, despite common assumptions. Most purchasing power exists as promises rather than physical currency. These promises expand and contract far more rapidly than production itself. Volatility begins precisely where credit accelerates. Credit creation appears harmless, almost magical in its simplicity. Two parties agree, a loan is recorded, and new spending power emerges. To the lender, it becomes an asset. To the borrower, a liability. Balance sheets expand without any immediate production. This expansion triggers consequences rarely recognized in real time. Borrowers increase spending beyond current income constraints. That spending becomes someone else's income, reinforcing optimism. Confidence rises before risks are even acknowledged. Rising income alters perceptions of safety and creditworthiness. Lenders observe higher earnings and growing asset values. Collateral appears stronger, default probabilities appear lower. Credit flows more freely, amplifying the cycle. A self-reinforcing loop quietly takes hold across the economy. More credit enables more spending and temporarily higher incomes. Higher incomes justify even greater borrowing capacity. Growth accelerates, masking underlying fragility. Productivity growth operates in the background with far less drama. It reflects improvements in efficiency, skills, and technological progress. Unlike credit, productivity changes slowly and persistently. Its stability makes it a poor driver of short-term swings. Debt, however, introduces instability through time-shifting consumption. Borrowing pulls future spending into the present. Payment forces future restraint, reversing earlier expansion. Every loan, therefore, plants the seed of a cycle. Short-term debt cycles emerge from these recurring expansions and contractions. They typically unfold over several years, not decades. Central banks influence their amplitude through interest rate adjustments. The machine responds mechanically to changing borrowing costs. When credit expands rapidly, spending begins to outrun production capacity. Demand pressures push prices upward across multiple markets. Inflation becomes the visible symptom of hidden credit dynamics. Concern replaces complacency at policy institutions. Central banks react by tightening financial conditions. Interest rates rise, borrowing becomes more expensive, and leverage slows. Existing debts demand larger servicing payments from borrowers. Spending decelerates, reversing previous momentum. Slowing spending triggers income contractions elsewhere in the system. Businesses experience weaker demand and reduce hiring or investment. Asset prices lose support as expectations deteriorate. Recession emerges not as an accident, but as a mechanical outcome. Lower interest rates often restart the process during ordinary downturns. Reduced borrowing costs encourage renewed credit expansion. Debt servicing pressures ease, allowing spending recovery. The cycle resets, though underlying debt gradually accumulates. Over decades, these short cycles compound into a larger trajectory. Debt levels trend upward faster than incomes for structural reasons. Human behavior consistently favors borrowing over restraint. Stability slowly gives way to systemic vulnerability. Rising asset prices temporarily disguise mounting debt burdens. Collateral values inflate, sustaining the illusion of safety. Borrowers and lenders interpret appreciation as genuine wealth creation. Risk perception declines precisely when leverage intensifies. Eventually, debt servicing obligations overwhelm income growth. Repayments consume increasing portions of cash flow. Borrowers reduce spending not by choice, but by necessity. The expansionary engine abruptly loses power. Creditworthiness deteriorates as incomes weaken and asset values decline. Lenders tighten standards, further restricting borrowing capacity. Asset sales accelerate under financial pressure. Deflationary forces intensify across markets. This phase marks the long-term debt peak and its reversal. System enters deleveraging, a painful adjustment process. Spending, income, and credit contract simultaneously. Feedback loops amplify downward momentum. Traditional policy tools lose effectiveness under extreme debt burdens. Interest rates approach zero, leaving limited room for stimulus. Private sector demand remains suppressed despite cheaper credit. The machine requires more forceful interventions. Debt reduction becomes unavoidable but politically and economically disruptive. Defaults erase liabilities yet destroy corresponding financial assets. Restructuring redistributes losses across institutions and investors. Confidence fractures under uncertainty. Governments confront declining revenues alongside rising social expenditures. Budget deficits widen as economic activity contracts. Tax increases and borrowing attempts strain political stability. Social tensions intensify within societies as central banks deploy money creation as a last resort mechanism. Newly created funds purchase financial assets and government bonds. Liquidity enters the system without immediate production. Set prices stabilize before real economies recover. Monetary expansion redistributes effects unevenly across populations. Asset holders benefit first through rising valuations. Wage earners experience delayed or muted improvements. Inequality concerns escalate during recovery phases. Coordination between fiscal and monetary authorities becomes critical. Central bank financing enables sustained government spending. Public expenditures support incomes and demand directly. The contractionary spiral gradually slows. Through these mechanisms, the economic machine regains temporary balance. Debt burdens adjust, confidence stabilizes, and credit cautiously returns. New expansions begin with familiar optimism and forgotten lessons. The cycle continues, indifferent to memory or ideology.
Alright, that's wrap for today. Thanks for watching Wealth Finance 61.